Start.
Good morning, Professor Chatterjee. My name is Rotimi Faramani. I'm here to present financial analysis for two companies, Harley-Davidson Motorcycle and Polaris Industries. Harley-Davidson is a company that has been existing in the last 120 years, and Polaris Industries is also a 65 years old company. Both of them are into the productions and manufacturings of motorcycles. Although for Polaris also produce other items such as equipment such as sports utility equipment, and then some military hardware equipment that are being used for sport purposes. To the point, we're going to look at their financial analysis, and the financial analysis we're going to look at are in different segments. We're going to look at the ratios of these two companies. We're going to look at the accounting measures of these two companies. We're also going to look at the cost of capitals of these two companies, and we're also going to look at the performances of the stock of these two companies in the New York Stock Exchange. So to start with, we're going to start with the ratio analysis of these two companies. And then when we're under the ratio analysis of these two companies too, we're also going to consider ratios in under 5 segments. We're going to look at the liquidity ratios of these two companies. We're going to look at the solvency or asset management ratios of these two companies. We're also going to look at the profitability ratio of these two companies. We're going to look at the market ratios of these two companies, and we're also going to look at the solvency of these two companies. To start with, we're starting with the liquidity ratio of these two companies. Right here on my hands, we have computed the current ratio and the quick ratios of Harley-Davidson and Polaris Industries. And we're considering the time series from 2000, the period under consideration is 2014 to 2018. The current ratio of Harley-Davidson from between 2014 to 2018 start with from about 1.65, and it's declined gradually to 1.25. And that of Polaris start from about 1.29, it fluctuates to 1.4 in 2015, 1.24, 1.11, and 1.24. What are we talking about here? We're talking about the fact that current ratio means current asset divided by current liabilities. The components of the current asset are accounts receivables, cash and marketable instruments, and so on and so forth, while the current liability has to do with notes payable and some other short-term credit liabilities. We are saying in this case and in this circumstance that as of 2014, the current ratio of Harley-Davidson was the current asset of Harley-Davidson can cover its current liability at one period of time into another 65% of the remaining of the current liability as at that point in time. But over years, by the time we're getting to 2018, this ratio had declined. Ditto for Polaris Industries. What can we say that accounted for this? A review of their financials shows that within this period, this company increased their short-term borrowing. And when they increased their short-term borrowing, why the current asset was not significantly increased, then there was a decline in the ratio. Why did they increase their short-term borrowing? They put it in short-term working capital, that's investment. We're moving from there to quick ratio. The quick ratio by computation shows current assets minus inventory divided by current liability. We also observe that the same trend in 2014, Harley-Davidson current quick ratio was 1.64, but by the time we're getting to 2018, it has come down to 1.09. Ditto for Polaris. The same thing, it comes from 0.62, it goes to 0.43. Again, the observation here is that we're talking about whatever is left out of current asset after taking away inventory divided by current liabilities. Does this company have the capacity to be able to pay their short-term creditors at the tip of a finger or the tap of a finger if their short-term creditors demanded for their money? That is what we're looking at here. And from all indications, this company is in position, the two companies are in position to be able to pay to meet their short-term obligations. We shouldn't forget that liquidity ratio is it talks about the lifeblood within an organization. That is the difference between it and profitability. An organization that is not liquid is like a human being that does not have blood. That's exactly what it means. So we're talking about the capacity to be able to have day-to-day working capital that they can use to start running their operations. As it is, yes, the two company has that capacity as it is, although with some kind of decline. From there we're moving to efficiency ratio. Efficiency ratios and stroke asset management ratio. The efficiency ratio here now is to try to measure the deployment of investment in assets that the company has made, both in working in current assets and in long-term assets. How does this asset generate funds? How does it generate revenues for these two companies? That's what we're going to look at here. Are they efficiently managed? Does this asset generate sufficient earning? Does it look like this asset is actually, when they put investment in asset is actually bringing in a very good returns and they are efficient in their way of operations? We're going to look at that. We start by days of sales and days sales outstanding. Days sales outstanding here says account receivable, which is average account receivable, average collection period. Account receivable multiplied by 365 days divided by credit sales. That's what we're looking at here. And for Harley Davidson, we're seeing that they left their money into the hands of their debtors this time around. In 2014, it was about 127 days. By the time we're getting to 2018, this has increased to 160 days. This does not reflect or portend some kind of efficiency. Leaving your money in the hands of debtors when you made sales and it's like almost half of a year before you could get your money back, it doesn't reflect some kind of efficiency. But for Polaris Industry, their ratio moves from between 17 days to about 11 days. In fact, it declined. This is still somehow within the industry average or quarters. That's it for the two companies. Then when we look at inventory turnover, the inventory turnover talks about cost of goods sold plus depreciation divided by inventory. That's it. So it tells us when they put inventory into production, how fast, as in the numbers of how fast were they able to turn over this inventory. For the two companies, their ratios are from in 2014 it was almost like 8.29 for Harley Davidson. It comes to 6.50. This is a form of efficiency because they were turning over this inventory very fast. Ditto for Polaris Industry. Their inventory turnover moves from 5.81 to 4.90. It shows that because the higher, as in the lower this number, the better it is. But that means their production process is very efficient and it moves very fast. So we move from there to inventory to net working capital management, net working capital. When we're looking at inventory to net working capital, we're looking at available inventory, then we divide it by net working capital. What are we talking about when we're talking about net working capital? We're talking about current asset minus current liability. Investment in working capital. To what extent is this investment? To what extent does it sustain inventory? Because part of this investment is what goes into inventory. On the other hand, because don't forget we just mentioned that up here. So we're looking at that ratio, and the ratio shows that 63% of Harley Davidson inventory represents their net working capital, and that was in 2018. In 2014, it used to be 29%. Somehow this ratio had grown. This is also not a good one because naturally it shows that there's a huge investment in inventory, investment in inventory is growing while investment in net working capital is shrinking or probably be at the same level. So this ratio is naturally supposed to be a ratio that the portion of the inventory that is being represented by the net working capital is supposed to be at minimum. Although for companies, again, optimality is an important issue here. And how do we determine optimality? Optimality is determined by the company. It says that this is our optimal mix, optimal product, optimal point whereby our investment at any point in time will be able to generate sufficient returns that will be satisfactory to the investors and to the management of the companies. So there are other factors we have to consider. So we move from there into the asset management turnover. The asset management turnover talks about the fact that when the company put assets into use, investment in assets, long-term assets, investment in short-term assets, how much of revenue or earnings were we able to get from this investment? That's what we're looking at. And from there we look at the total asset turnover. The total asset turnover talks about total sales, which is total revenue divided by total asset. And what are we talking about? We're looking at it that, okay, $1 investment in asset, how much sales or revenue was this dollar was able to generate? For Harley-Davidson, this was able to generate just about 65 cents. And in 2014, it has declined to 54 cents. Naturally, the higher this ratio, the better it is. From there, we move to fixed asset turnover. In fixed asset turnover too, we're also looking at a dollar investment in fixed asset, how much revenue was it able to generate? The trend remained the same. It also declined from 7.50 to 6.52 for Harley-Davidson, but for Polaris too, it also declined. It shows that investment in fixed asset was not generating sufficient revenue or higher. So the industry average, they were within the industry average, but again, they can improve better on this. From there, we move to long-term solvency or financial leverage. Long-term solvency and financial leverage is talking about the fact that, okay, does this company has the capacity to be able to pay back their interest and pay back loan that is being used to finance their operation? That is what is critical in this case. And what are we looking at when we want to consider that? For instance, we want to look at, okay, numbers of times interest earned. The numbers of times interest earned, is defined or explained as earning before interest and tax divided by interest expense. If, for instance, when we look at Harley-Davidson can cover its interest over 300%. In 2014, although it declined again to like 23 times in 2018, but this is still very comfortable. The same thing, Polaris can cover its interest minimum of 8 times or 9 times in 2019. That means the earnings that they generate can cover their interest as many times as possible. We look at their debt ratio. The debt ratios is talking about total liabilities all over total assets. For here, in 2014, the debt ratios of Harley-Davidson was 69%, meaning that the total liabilities divided by total assets is just 69%. But by the time we're looking at 2018, it has grown to 83%. It simply means that the total liabilities that Harley-Davidson is carrying in 2018 is about 83% of the total assets. This may not portend a very good signal. But again, what is coming out of this, when we review the financial, it shows that there's so much of investment, capital investment that these two companies were embarking upon. Do not forget, these companies are into productions of heavyweight motorcycle with modern technology. So they are continuously investing on their manufacturing process and with the applications of modern technology. It rubs off on a lot of other things we're going to see later, even as we progress in this. From there, we move into the profitability ratio. The profitability ratio is talking about, okay, we have invested this much. How much of profit are we getting from this investment? That's what we're looking at in this circumstance. And we're looking at, okay, the investment we have put into asset, the investment we have put into fixed asset, the investment we have put into current asset, how much of profit, how much of net income, how much of earning before interest and tax are we generating from this? That's what we're looking at in the whole of this. The total profit margin in 2014 was just 43%. And in 2018, it was 41%, just a little decline. It shows that it's still within the industry average, and this is a very good one when it comes to total profit margin. The net operating margin, if we look at it, the net operating profit margin shrink. In 2014, it was 21%, and in 2018, it becomes 12%. If we look at the difference, it shows that the management control cost, which is selling and administration cost, other costs, the management control cost has a lot the company must have been spending so much there, and then the management need to put this under control. We look at return on asset. We're going to read straight. Return on asset shows that as at 2014, it is 9%. In 2018, it comes down to 5%. It shows that this is declining. And why is it declining? It shows that net return on asset talks about net profit divided by total asset. It shows that it's either the company's income is the net profit is the net income is declining, or investment in asset is increasing. In this case, we can confirm to you that investment in asset was increasing. The net income was more like, the graph was a bit somehow very parallel. From here, we move to return on equity. Return on equity is what the shareholders themselves that put down their money, what they are expecting. It is net profit divided by shareholders' equity. It was 29% in 2014. It remains on 30% in 2018. Shareholders were not playing with their returns. That's what it is. It's still that high, but it has implications. So from there, we move to the market ratio. The market ratio is talking about the relationship between the market price of the shares in line with the growth potentials in the company and the earnings in the company. The first ratio we're going to consider here is the price earning ratio. The price earning ratio shows the ratio at which an average at any point in time the market price of each of these company, how long does it take for you to recoup when you pay $42, for instance, a share price of Harley-Davidson, and the earning per share of that company is about $5. It tells you how many times or how long it's going to take for you to be able to recoup your share price. That's what it means, or the amount you pay for that share price. The market and price earning ratios is the market price of the shares divided by earning per shares of that company. And for Harley-Davidson, it was 14.27 in 2014. It has come down to 12.68. Naturally, the expectation here is that price earning ratio should keep going up. That should have been the better case here, but it's declining. For Polaris industry, it grew just marginally. That's it. From there, we moved into the cash flow per share. Cash flow per share is net income plus depreciation divided by the numbers of shares that is outstanding. Cash flow per share remain relatively within the same range within all through the period under consideration. From here, we move to, because investors are interested in all these ratios to be able to determine if their investment in this company is actually worthwhile or not, or if they have to dump their investment in that company. They look at dividend yields, they look at dividend PR ratio, and they look at dividend per shares. So we move from there. From here, we move into the accounting measures. Accounting measures has to do with looking at the books of these companies, looking at the balance sheet, looking at the income statement, looking at the cash flow statement. We want to know what value is this company's operation adding or bringing back to the investors, which is the average shareholders or bondholders that has put their money down. That's they want to see, because this is an area whereby the performance of management and whoever is managing the company is really being measured. Are you adding value back to us, or you are not giving value to us? We're looking at net operating working capital. Net operating working capital is talking about current assets less marketable securities, then minus current liability less note payable. The difference between them becomes net operating capital. We're talking about capital that are being put into the day-to-day running of the manufacturing process, which is the operating process itself. That's what net operating capital is talking about. Here, the figures move and it declines as at 2018 from 4.something billion to 2.04 billion. For both companies, the figures were declining. From there, we move to total net. From there we move to net operating profit after tax, which is NOPAT. NOPAT is what naturally is being used to measure what a company is earning in terms of how much profit a company is making when this company does not engage in debt or other financial assets. NOPAT is earning before interest and tax, earning before interest and tax multiplied by 1 minus the tax rate. That's what NOPAT is. NOPAT is talking about that, okay, with taking away the absence of debt, where there is no debt or payment of interest on debt, what exactly is this company making. It enable investors to be able to measure that investment in asset, the investment we put in asset for this company to continue to produce and to manufacture. Are we generating? Are we getting anything from it? The higher the no part, the better it is. For these two companies, they have the optimality has to come in here for these two companies. But as it is, their no part are positive. Then we move to free cash flow. The free cash flow talks about what exactly is left for the investors to distribute after they have met the investment requirement in operations, having put investment into machineries, into plants, and into working capital. What exactly is the cash flow that is left? The free cash flow is actually what is being measured to value the performance of managers, that okay, are you really bringing back value to we the equity investors or the shareholders? The free cash flow, in fact, that is why in another context, valuations of companies is being done on the basis of free cash flow. That is it. So that's what the free cash flow does. Then we move from there to the other ratios, like the market value added, the economic value added. These ratios too are measuring clearly what value is being added to the performance of this company in a specific year. Is this company operations, is it adding value? Is the value increasing? And what do I talking about when we're talking about value here now? We're talking about value in terms of dollars. What value does this company bring onto the table at the end of a financial year? Is this company growing? Is it bringing value, or the value is depleting? These are the things we're looking at here. For these two companies, really they are adding value within those very particular period. They are adding value. It's very clear here. The figures are there showing that they are adding value. So then the shareholder preference now will come into play in this case, that okay, the value you are adding, is it sufficient for me? Because do not forget, an average investors are looking for, they are ready to take as much that can come in, regardless of whatever the situation is. They want more and more and more. So we are looking at it that is this the investors preference will come into play. But when it comes to are they adding value, yes, in most cases all through the whole period value are being added. And one of the ways to also see that is to see the market value added, and then the economic value added. That is the way it is. So from there we move to the cost of capital. Yes, I need to mention at this point in time that valuations of cost of capital here, particularly for equity investor, is done. I did my valuations on the basis of the dividend valuation model, and the dividend valuation model states that the market price of any company is the future dividend, expected future stream of dividend that is coming in from that company, or that the company's operation is generating, discounted at the investors or the shareholders' marginal cost of capital. So that is the basis upon which I did the valuation here. And as in I'm talking of the cost of capital, we observe that these two companies, Harley-Davidson issued some bonds, and the cost of debt after tax were respectively stated here. From year 2014 to year 2018, they have a lot of bonds that are out there. So Harley-Davidson in their balance sheet is being financed by a mixture of bonds and equity. But for Polaris by way of financing from external investor, Polaris can be termed, quote unquote, as an all equity finance company, because Polaris does not issue any bond, but right in their balance sheet, Polaris has specific or some kind of arrangement with banks that they borrow on long term, and they have revolving loans. The cost of the borrowing and the revolving loans are also being considered. Looking through their 10K that was submitted to Security and Exchange Commissions, we were able to bring out the cost of this debt. We consider that. And when we look at the cost of capital here, the cost of capital, after computing the cost of debt, we look at cost of external equity. The cost of external equity here comprises of the growth in we take into consideration the growth in dividends. The growth in dividend comes from the angle of the return, which is ROE multiplied by the retention rate. We consider that on yearly basis. Then we look at the dividend the companies pay. The beauty of it is that for the 5 years under consideration, we must state clearly here at this point in time that the company paid dividends. They pay dividends, and the dividends paid are being stated. So when we look at the cost of external equity, we are looking at dividend that was being paid divided by the market price of the company, then plus the growth in dividend. That gives us the cost of equity for these companies. Then we are going to look at the weighted cost of capital now, which is the WACC. What is being done is to consider the cost of debt and the cost of equity. And then with the capital structure of this company, we also taken into consideration. The capital structure of this company are stated here. Naturally, Harley-Davidson has a 57% in equity and 42% in debt in his capital structure. Polaris has 77% in equity and 22% in debt. I just said it earlier. I said Polaris is more of an all-equity finance. They only have some kind of long-term borrowing in their balance sheet, arrangement with banks, and then some kind of revolving loans also arranged with banks. So when we look at the weight of the capital, as in the weight of equity and the cost of equity, the weight of equity, which is the weight of equity divided by the total weight of the capital structure, multiply the cost by the cost of equity, then plus the weight of debt divided by the total weight of in the capital structure, multiplied by the cost of debt. It gives us the weighted average cost of capital. And that's how we're able to arrive at the weighted average cost of capital for each of the companies for those numbers of years. This is this analysis on the financial ratios and the accounting measures end there. From there we quickly move to look at what is the stock, what is the positions of the stock or the performances of this company in the stock market. A review of the performances of this company in the stock market is also here. In this case, we consider the market here now is Dow Jones. What we consider as our market here is Dow Jones. Dow Jones is the industrial average. We look at the stock price of this company for 2 years. For Harley-Davidson, their daily stock price, historical. We look at the daily stock price of Polaris for those 2 years. And then we look at the trend, the performance trend of the stock alongside with the performance of the market. This is Dow Jones. This is the performance of the market over 2 years. This is the performance of the stock of Harley-Davidson over 2 years. It was declining. The performance of the stock of Polaris Industry over 2 years it moves up and down, and there was some kind of zigzag. So that's exactly how this one is. From there we look at then doing a regression analysis to find out how the relationship between the performance of the performance of the stock of Polaris and Harley-Davidson with that of the market. Because do not forget, the performance of Polaris, the performance of Harley-Davidson, and the performance of some other companies within the market is what eventually constitutes the performance of the market. So the performance of the market is what constitutes our Y variable. Here, again, the performance of the market is what constitutes our Y variable, which is the dependent variable. The performance of each of these other stocks becomes the market line. It becomes the intercept. So when we did a regression analysis on it, we find out that for Polaris Industry, obviously, we could see very clearly here, the intercept was going down. It was in negative. Why was it in negative? It was in negative because the trend, the stock performance of Polaris, again, which we just reflected here, over the years between 2017 to this moment, it was declining. In fact, it was in the historical cost, it was right there. It was about $50-something as at 2017. But by the time we're going to get to 2019, this stock price has gone down to like $40. So, and it lost about 27 to 37% of its value between those 2 years. For Polaris Industry, Polaris does not lose value in terms of percentage. The stock price was about $70-something in 2017, and as at this point in time, the price as at the right time of writing was about $98. So it was not, it goes ups and down, you know, naturally, just the same way the price of stocks will keep fluctuating here and there, depending on a lot of situations and depending on what happens in the capital market, what happens in the company's informations and other things. It fluctuates here and there. But on a final analysis, it is very clear that Polari was losing stock value here, and then why Harley-Davidson was losing stock value here, while the stock value of Polaris remained consistent. So on a final conclusion, a combination of the whole of this financial analysis that has been made is what determine the strength, the weakness, the performances of a company at any point in time, and it also rub off and reflect what the share price of this company is going to be in the market at any point in time. Let's not forget, what is the essence of all this? A ratio does not on its own, a single ratio on its own will not make any meaning. We can only get the benefit from ratio analysis by looking at the time series. What was this ratio in 2014? What is this ratio at this point in time? We can only get the benefit of ratio analysis and financial analysis by comparing industry together, and that is what we have just done here. We look at the case of Harley-Davidson and we also look at the case of Polaris. How are these two companies faring? And then we can only get value, we can only appreciate the values of this financial analysis by looking at, okay, what is the position of each of these companies relative to the position of the market? Are this company going in tandem with the market, or they are going, there's a kind of inverse relationship, or the correlations is not there between them and the market? Then if it happens that way, the expectation is for these companies to look at it, that to come up with strategic initiatives that they can use to make sure that, okay, they align their performance with what is going on within the industrial trend. They align their performance, they look at, okay, whatever their area of weaknesses are, and they improve on it. And then they also find a way of determining optimality in terms of capital structures, in terms of earnings, in terms of investment in assets, in terms of even leverage, financial leverage. How much do you want to borrow? We want to look at all these means, because these are things that in a way also affect the cost of capital. And what are we talking about? The cost of capital is exactly the rate at which an investor is going to demand on whatever capital that they put on ground. The rate of return that is required by an average investor is the cost of capital. So as I said, on the final analysis, a combination of the whole of all these indices that has been explained is what is required at any point in time for a company to be able to determine where they are and what they need to do in case they still need to do some things to get to where they're going. This is what is required for them to be able to, when they look at this, they x-ray themselves, they look at areas that need improvements, and they have to come up with strategic initiatives to improve on that, and they look at areas where they are doing well, and then they keep sustaining that. That is the end of this presentation. Thank you.